We want to talk to you now about fixed income instruments outside the realm of debt mutual funds. And this is useful to quite a lot of you because, in fact, especially those that are more risk averse tend to choose instruments that they view as safe. So we'll speak about the various options available and the context that we're in right now with bond yields rising across the globe. Let me introduce my guest today. We've got Harshvardhan Roongta, who's the co-founder of Roongta Securities. Thank you so much, as always, Harsh, for taking the time. Appreciate it. Let's start with the context first, which is that we might just be reaching the end of the current interest rate cycle, and we might be heading towards higher interest rates. Is that something that you think investors should pay attention to, and how can they incorporate that into their personal financing?
Hi, Alex. It's always a pleasure to be on the show. Just to put this in perspective, I mean, on a realistic note, it is very difficult for a layman investor to actually monitor or track the interest rate movements in the economy. I mean, leave aside predicting which side the interest rate will go and what will be the interest rate in the future. So, even if an investor can actually do that, so just imagine a situation that a person is sitting with, say, probably 10 lakhs of money in hand and looking to generate some regular income. She's a senior citizen or a person majorly dependent on interest income. So you're sitting on 10 lakhs of corpus and you would wait for interest rates to move up. Now, if you're going to do that, you're going to lose a lot of money while just sitting on that money without parking it away. So on a practical note, it is not possible for a layman investor to keep monitoring and tracking these interest rate movements. So you rather park that money away. You may not lock in for long term, but at least you will need to put that money away. So, coming to this point, what is going to be the impact and how can you benefit out of it? So, well, even if you look at the significance, so if the interest rates in the economy possibly go up by, say, 50 basis points, it is unlikely that the banks or any deposit accepting institution will increase the interest rates by 50 basis points. You will see a maximum increase in interest rate by about, say, 25 basis points. So the real, the benefit of rising interest rates was not going to come to the depositor in the entire in the entire amount itself. And when you talk about senior citizens or any other person for that matter who's dependent on fixed income, instruments, I mean, you will see that the impact, the damage is actually twofold. One is, of course, the interest rate income will keep falling and the expenses are going to go up. So yeah, it's a very difficult situation that you need to balance out and create a portfolio accordingly.
Okay. Now, I'm sure that a lot of our viewers tuning in will like to hear the various options available, Harsh. And there are numerous options available. It's not just fixed deposits and recurring deposits. So let's list them out. And maybe you can also comment on which of them stand out in terms of which are better than the others, perhaps.
Yeah. So, Alex, if you were to understand the Indian mindset, I mean, an Indian investor is, generally very comfortable when he or she knows the kind of returns they will get. So, which is nothing but the predictability of the returns that you're going to get. So, we talk about a debt investor, a non-equity fixed deposit or a fixed income instrument investor. There are two options. One is, of course, you have your post office deposits, your bank fixed deposits, small savings schemes. You have all of those which give you which tell you what is the rate of return that you will get over the next 5 years, 10 years, whatever is the period of your deposit. On the other hand, you will have a debt mutual fund. I mean, these are the schemes offered by mutual funds, which predominantly invest into bonds and certificates, CDs and CPs, etc. Now, there is unfortunately no guarantee of returns. There is no indicative or even predictability of returns in that sense. So that is why you are seeing that the investors in the debt category especially tend to prefer these deposits, which are from offered by post office and etc. Now, if we were to look at the popular options in the non-debt mutual fund category, so the ones which give you a fixed coupon rate payouts, so it's more predictable, you know exactly what your cash flows would be. There are a few which you can consider. Once, and I'm talking about senior citizens particularly, or those who are retired and dependent on interest income. So the first one, of course, the most popular for senior citizens would be the senior citizen savings scheme. Now, this scheme pays out 7.4% annualized interest, and the interest is paid out quarterly. You have the Pradhan Mantri Vaya Vandana Yojana, which is a pension policy offered by LIC of India, and the rate of return that you generate on that is also 7.4% per annum. You have the post office monthly income scheme, which is a 6.6% interest, annual interest paid out monthly to you. You have a couple of other options. Then you have post office offers you time deposits. Now these are deposits from 1 year to say 5 years, and the rate of interest would be about 5.5% to say 6.7%, depending on the tenure that you take. You have RBI floating rate bonds, which are interest is floating in nature, reset every half yearly. The current interest rate being at 7.15% per annum. Then you would have listed tax-free bonds, the bonds which were issued earlier. Interest is tax-free in your hand, and that is listed on exchanges now where you can buy and sell. The yield on that would be about 4.5%. Now, this is very good for those people who are in 30% or high income tax bracket, because net of all income tax, if you're getting a 4.5% yield tax-free in your hand, that seems to be better than getting probably a 6.5% taxable. So yeah, there are a couple of other options available in the fixed income instruments, which an individual can certainly consider.
Okay. Having said that, let's also give people a little bit of advice in the current context, right, Harsh? What are you telling people that come to you and ask about fixed income investments?
Alex, the issue of concern when you're talking about interest rates going up, primarily would come and be faced by debt mutual fund investors. So, in case you're invested in debt mutual funds, and we are all expecting interest rates to go up sooner or later, you will see the impact on debt mutual fund NAVs. So, interest rate movement, interest rate and prices of bonds are inversely related. So, when interest rates go up, you will see the prices of bonds coming down. So the debt mutual funds, in case of interest rates going up, you will see the NAV coming down. So there will be a mark-to-market loss. And more particularly, if you are invested in debt mutual fund schemes, which are long duration funds, it's about time, I think you should switch to shorter duration funds. Because if interest rates were to go up, you will see that the impact on longer duration funds, the negative impact, so basically the fall in NAV, will be more on the long-term debt funds rather than the short-term funds. So in case you're invested in the long-dated bond funds, debt funds, you need to switch to shorter duration funds. The outlook that I see for any debt mutual fund scheme per se would be, you're expecting a return of between 4 to 6%. I mean, that's the kind of returns that any debt scheme for that matter, you should be expecting out of your investment. Unless you're going into fixed deposits that I referred to, you had those options of post office time deposits and the others that I spoke about, or a company deposit where you can get a deposit, a return between 6 and 6.5% for highly rated corporate bonds, FDs rather. So this would be essentially the outlook for debt investors right now. If you are a person, as I said, if you're a person who's senior citizen in age and or majorly dependent on interest income, then I think you would need to look at fixed instruments such as your post office or small string deposits, bank deposits, and corporate deposits.
Let's talk about that aspect a little bit more. In fact, what strategies should a senior citizen employ? And obviously, the advice that should come, I think, and I think you also think the same way, Harsh, is that you can't put all your eggs in fixed income. You have to also have a certain amount of allocation that will help you grow your capital. So how should a senior citizen approach this?
Well, so I'll just break this down into two parts, just to add into one bit of options that mutual funds offer. I mean, that is the target maturity fund. So, just to bring that into perspective, as well as to talk about the portfolio allocation that you spoke about for the senior citizen. So let's start with the senior citizen allocation. So what I would suggest at this point in time is that your corpus, if you have say 100 rupees to invest, 80% of that, so about 80 rupees for that matter, should go into your senior citizen savings schemes, the products which give you a fixed interest right now. And such as the senior citizen savings scheme, there is a limit of 15 lakhs that you can put per person. You could look at the Pradhan Mantri Vaya Vandana Yojana, which also helps you put about 15 lakhs over there. You have a post office monthly income scheme in which the individual can invest up to 4.5 lakhs. And if there are joint names, then you can go up to 9 lakhs that you can invest. Once you've exhausted these limits, then you should look at allocating towards your post office time deposits or highly rated corporate bonds. One more category that you have, which you can consider, is a target maturity funds, though there would not be regular interest payouts on that, but there is primarily an indicative yield that you will generate. And because it's a target maturity fund, the investments and the papers are held to maturity with the same timeline as much as the duration of the fund. So that is one option. And as you rightly said, that you cannot have all your money into fixed income instruments and then expect to beat inflation and get a return which actually is positive of your cost of living going up. So you will have to have 20% allocated towards hybrid funds. Now, hybrid funds, you could have different categories. You have a balanced advantage fund, which has a portion of the corpus invested into equities. You have a conservative hybrid fund, which has up to 25% of equity allocation within the scheme itself. Or you have an equity savings fund, which again has some portion of equity investment. Now, the idea of having 80% of your money into fixed income instruments, which generate a fixed rate of interest, is that predictability of cash flows. Now, the intent to beat inflation is also going to be inherent. So that is why we are taking 20% allocation towards those schemes which have equity allocation and which over a period of time are expected to give you returns in excess of what your standard or a routine debt scheme would give you.